While you're watching this video, there's a time bomb ticking inside the U.S. banking system. And this time, FDIC insurance might not save your money. Over the past 18 months, the value of assets held by American regional banks has dropped by $620 billion. That's not a typo. $620 billion simply evaporated, and the Federal Reserve keeps raising rates as if nothing is happening. You know what's truly terrifying? Silicon Valley Bank was just the first domino. Signature Bank fell next, then First Republic. But what happened in March 2023 wasn't the final chapter, it was the prologue. Right now, 4,600 regional banks operate in the United States. According to FDIC data from January 2025, 722 of them are classified as problem banks. That's 15.7% of the entire system. For comparison, before the 2008 crisis, that number was 9%. These banks hold the savings of 67 million Americans. Mortgages, small business deposits, retirement accounts, the total sum, $2.8 trillion. And here's what's worse. The FDIC Deposit Insurance Fund has only $128 billion in reserves. That covers 4.5% of insured deposits. If a wave of bankruptcies begins, and it will, this money will last a week, 2 weeks maximum. You think the government will just print money and bail everyone out like in 2008? I have news for you. Inflation in the U.S. is already at 3.2%. The national debt stands at $36 trillion, and interest payments on it consume $1.1 trillion per year. That's more than the Pentagon's budget. The Fed raised its base rate from 0.25% in March 2022 to 5.5% in January 2025. This is the most aggressive rate hiking cycle in the last 40 years, and every percentage point is another nail in the coffin of regional banks. Jerome Powell, the Fed chairman, said at his last press conference on March 18, 2025, "The banking system remains resilient and well capitalized." You know who said almost identical words? Ben Bernanke on September 15, 2008. Hours before Lehman Brothers declared bankruptcy and triggered the largest financial crisis since the Great Depression. History doesn't repeat itself, but it rhymes. And right now, I'm going to show you why that rhyme is getting louder and louder. Are you ready for what happens when the system finally breaks? To understand why we're standing on the edge of an abyss, we need to go back, not a year or two, a full 15 years. December 2008. The financial system lies in ruins after the Lehman Brothers collapse. The Federal Reserve, under Ben Bernanke's leadership, makes an unprecedented decision: lower the base rate to 0.25% and launch a quantitative easing program, QE1. The concept is simple. The Fed starts printing money out of thin air and buying bonds. First $600 billion, then QE2. Another $600 billion, QE3 in 2012, $85 billion every month, until the Fed's balance sheet swelled from $900 billion to $4.5 trillion. The idea was this: cheap money would help the economy recover. And on paper, it worked. The stock market soared, unemployment fell, everything looked beautiful. But there was one problem. A massive problem. When rates are close to zero, banks start playing a dangerous game. They take cheap short-term deposits at 0.5% annually and invest them in long-term bonds yielding 2 to 3%. This is called maturity transformation, and it all works perfectly until rates start rising. Here are the numbers for you. A hypothetical regional Bank of America bought $50 billion in 10-year Treasury bonds in 2020 at 1.8% yield. By the end of 2024, the yield on these same bonds jumped to 4.5%. What does that mean? The price of these bonds fell 25-30%. The bank has $50 billion in assets on its balance sheet, but if it tries to sell them right now, it'll only get $35-37 billion. The difference, $13-15 billion in unrealized losses. So what, you might ask? Banks don't sell these bonds. They hold them to maturity. The losses are only on paper. True. Until depositors start withdrawing their money. March 2023, Silicon Valley Bank, the 16th largest bank in the U.S., assets, $209 billion. It serves Silicon Valley startups, venture funds, tech companies. SVB had the classic problem: $120 billion in long-term bonds purchased during the zero-rate era. Unrealized losses, $17 billion. As long as everyone stays calm, everything's fine. But Fed rates are rising, venture financing dries up, startups start burning cash and withdrawing money from SVB. In one day, March 8, 2023, clients withdrew $42 billion. That's 20% of all deposits in one day. SVB had to sell bonds at a massive loss. Investors saw the bank had a capital hole. Panic ensued. On March 10th, regulators shut down SVB, the largest bank failure since the 2008 crisis. 2 days later, the same story with Signature Bank. $110 billion in assets closed on March 12th. The panic spreads to First Republic Bank. Despite an emergency injection of $30 billion from America's largest banks, depositors withdraw $102 billion over 3 weeks. First Republic falls on May 1st, 2023. 3 major banks in 6 weeks. Combined assets, nearly $550 billion. And what does the Federal Reserve do? Jerome Powell launches the Bank Term Funding Program, emergency lending for banks totaling $297 billion, a temporary measure to prevent panic. But here's the paradox. Simultaneously, the Fed continues raising rates in May 2023 to 5.25%, in July to 5.5%, and it keeps them at that level until January 2025. Why? Officially, to fight inflation. But each increase makes the holes in bank balance sheets deeper and deeper. Let's look at the numbers. According to FDIC data for Q4 2024, unrealized losses in the U.S. banking system, $683 billion. For context, that's more than the entire capital of 200 small banks in the country combined. But the most interesting part is the distribution of these losses. The largest banks, JP Morgan, Bank of America, Citigroup, Wells Fargo, they're diversified. They have investment divisions, derivatives trading, international operations. Yes, they have losses too, but they can digest them. Regional banks are a completely different story. Their business model is simple. Take deposits, issue mortgages and business loans, buy safe bonds. When rates are low, the model works. When rates are high, the model collapses. And you know what else? Regulation. After the 2008 crisis, the Dodd-Frank Act appeared, a law tightening requirements for banks. But in 2018, Congress, under lobby pressure, softened these requirements for banks with assets under $250 billion. Guess what size Silicon Valley Bank's assets were? $209 billion. They asked to be exempted from strict stress tests. Congress agreed. 5 years later, the bank collapsed. Were there signs of the approaching catastrophe? Of course there were. JP Morgan analysts published a report in October 2022, 5 months before SVB's collapse, where they directly warned regional banks are sitting on $400 billion in unrealized losses, and if rates continue to rise, some of them will go bankrupt. The Federal Reserve ignored the warnings. Moody's had been downgrading dozens of regional banks since August 2023. The market ignored the signals. Even after 3 banks collapsed, the system decided the worst was over. The Bank Term Funding Program closed in March 2024. The Fed started hinting at rate cuts, but never actually cut them. And here we are. October 2025, rates still at 5.5%. Unrealized losses have grown to $683 billion, 122 banks in the danger zone. And now the most interesting part begins. Let me walk you through the stages. I'll show you exactly how the crisis will unfold. This isn't fantasy. This is a logical chain based on what already happened in 2008 and 2023. Only this time, the scale will be much larger. So imagine it's late October 2025 and something goes wrong. Imagine Pacific Western Bank, a real California bank with $41 billion in assets, publishes its quarterly report. Profit dropped 47%. Reason, rising deposit costs. The bank used to pay depositors 1.5%. Now it has to pay 4.5% to keep the money. But income from old loans and bonds remained at the previous level. Net interest margin, the difference between what the bank earns and pays, shrank from 3.2% to 1.1%. The bank is still profitable, but barely. Shares fall 23% in one day. Analysts start digging deeper, and they find unrealized losses on bonds, $8.9 billion. That's 78% of the bank's capital. Twitter explodes. Reddit forums are buzzing. Financial bloggers make videos. Is Pacific Western the next SVB? Large corporate clients start quietly withdrawing deposits. Nobody wants to be the last fool. Over 2 weeks, Pacific Western loses $12 billion in deposits, almost 30%. The bank is forced to sell bonds to return money to depositors. Losses materialize. Capital melts away. November 14, 2025, regulators announced that Pacific Western doesn't meet minimum capital requirements. The bank closes. FDIC takes it under control. $41 billion in assets, 1.2 million accounts. 67% of deposits exceed the $250,000 insurance limit. The government announces that all depositors will be protected, as with SVB. But this costs FDIC $14 billion, remember? They only have $128 billion in reserves, already minus $14. Now depositors are looking at other regional banks. Western Alliance, Zions Bancorp, Comerica, KeyCorp, they all have similar problems. Rating agencies start mass downgrades. Moody's places 89 regional banks under review for possible downgrade. What economists call a silent bank run begins. Not lines at branches like in the 1930s. People just log into their mobile app and transfer money to JP Morgan or a Treasury money market fund. Over 3 weeks, regional banks lose $340 billion in deposits. That's 12% of their total base. Banks are losing deposits. That means they have less money for lending. They start sharply cutting new loan issuance. Small business gets hit first. That local restaurant that took out a $200,000 loan every year for food purchases and salaries, the bank refuses. The developer, who planned to build a 50-unit complex, project frozen, no financing. According to Federal Reserve data, regional banks provide 80% of small business loans and 60% of commercial mortgages. When these banks stop lending, economic activity freezes. By January 2026, commercial loan issuance falls 31%, the worst figure since March 2009. Now let's remember commercial real estate, office buildings, shopping centers, hotels. After the COVID pandemic, offices emptied out. Work from home became the norm. Office building occupancy in major U.S. cities, 47%. That means more than half the space is vacant. The owners of these buildings took loans from regional banks. Total volume, $2.9 trillion. And here's the problem. These loans were issued at 3.4% in 2019-2021. Now when refinancing, the rate is 8-9%. Owners can't pay. There are no tenants. Building values have fallen 40%. Defaults begin. By February 2026, delinquent commercial mortgage payments reach $180 billion. Banks are forced to write off these loans. Another $67 billion in losses. Winter 2026. It's no longer one or two banks. This is systemic collapse. 18 regional banks declare bankruptcy from November 2025 through March 2026. Combined assets, $670 billion. FDIC runs out of money in January. The government is forced to emergency allocate $200 billion from the budget to save depositors. But politics intervenes. Republicans in Congress block the bill. We won't bail out bankers with taxpayer money again. Democrats respond, this isn't bankers, it's millions of ordinary Americans. 2 weeks of political horse trading. During this time, 3 more banks fall. Finally, they pass the law, but with a condition. Bank shareholders and bondholders completely lose their money. Bail-in instead of bailout. The bank bond market collapses. Investors holding these securities, pension funds, insurance companies, ordinary people through ETFs, lose $290 billion spring 2026. The banking crisis metastasizes. Automotive industry. Dealerships take loans from regional banks to purchase cars. No loans means no cars on lots. New car sales fall 22%. Ford and GM announced the closure of 3 plants, 35,000 jobs. Construction. Developers can't get financing. Started projects freeze. 840,000 construction jobs, cut or at risk. Unemployment in the sector jumps from 4.1% to 11.3%. Retail, small businesses that didn't get loans start closing en masse. According to Yelp data, from November 2025 through May 2026, 340,000 small businesses closed permanently. That's 4.1% of all small businesses in the U.S. The American banking crisis doesn't stay in America. European banks hold American corporate bonds and mortgage-backed securities worth $1.8 trillion. When these assets lose value, European banks also suffer losses. Deutsche Bank, Societe Generale, Credit Suisse, which was already rescued by UBS in 2023, their shares fall 40-60%. The European Central Bank is forced to launch an emergency lending program worth $400 billion. China. Chinese banks provided $670 billion in loans to American companies and projects. Defaults are growing, and China has its own problems: a real estate market crisis, local government debts. The banking crisis in the U.S. delivers the final blow to an already fragile situation. Emerging markets. The dollar strengthens amid the crisis. Investors flee to safe assets. Countries with dollar-denominated debts, Argentina, Turkey, Pakistan, Egypt, can't service their obligations. A wave of sovereign defaults. The IMF is paralyzed. It can't save everyone simultaneously. By fall 2026, it becomes clear this isn't a temporary crisis. This is a structural break. U.S. GDP for Q2 2026 contracts 2.8%. That's recession. Unemployment reaches 8.2%. The stock market falls 34% from 2024 peaks. $9 trillion in wealth evaporated. The Fed tries to lower rates to 2.5%, but it doesn't help. Banks still aren't lending. They're licking their wounds. A new round of quantitative easing launches, QE4. The Fed prints $2 trillion and buys bonds, but this is fuel for the next crisis. The debt bubble grows even larger. The system has reached a point where fixing it with old methods is no longer possible. A year or two after the crisis begins, the world looks different. Banking system consolidation. Of 4,600 regional banks, fewer than 3,000 remain. The rest either went bankrupt or were absorbed by large banks. J.P. Morgan, Bank of America, and Citigroup now control 68% of all deposits in the U.S. It used to be 47%. Too big to fail became too big to exist. But nobody can do anything. There's no alternative. Death of the middle class. The American middle class loses an average of 34% of its wealth. That's falling home values, collapsing retirement portfolios, job losses. The generation that planned to retire in 2026-2030, millennials with 401k plans, postpone retirement 7 to 10 years. They have to work until they're 72, 75. Social inequality. The wealthiest 1% recovers quickly. They're diversified, have access to the best opportunities, can buy assets at market bottoms. The bottom 50% ruined. The Gini coefficient, a measure of inequality in the U.S., reaches 0.52, a level comparable to Brazil or South Africa. 5 years after the crisis began, trust destroyed. An entire generation no longer trusts the banking system. Growth of alternative finance, cryptocurrencies, peer-to-peer lending, digital assets. Bitcoin reaches $450,000 per coin, not because blockchain is magical, but because people no longer trust traditional institutions. Geopolitical shift. China uses the crisis to promote the yuan as an alternative reserve currency. By 2030, 28% of international trade is denominated in yuan. In 2023, it was 3%. The dollar loses its status as the world's only reserve currency. It's a gradual but irreversible process. Political radicalization, economic trauma breeds political anger. In the 2028 elections, populists from both parties win, promising to destroy the system. Regardless of party, politics becomes more protectionist, nationalist, anti-globalist. The world that existed since 1945, a world of American hegemony, global trade, integrated markets, begins to fragment. And it all starts with what's happening right now. The Fed is keeping rates too high for too long, and regional banks are slowly bleeding out. Now, let's talk specifics. Not abstract people will suffer, but real numbers, real losses, real lives. Because when the system breaks, the impact is distributed unevenly. Some lose everything, some lose nothing, and that's not coincidence. That's a feature of how the financial system is designed. Remember, FDIC insures deposits up to $250,000 per depositor per bank. Sounds secure, right? But look at the numbers. In the U.S., there are 67 million accounts in regional banks. Of these, 58 million accounts are below $250,000. These people are technically protected. 9 million accounts are above $250,000. That's small businesses, professionals, retirees with savings. Total uninsured deposits, $1.4 trillion. When a bank goes bankrupt, what happens to amounts above the limit? In SVB's case, the government made an exception and protected all deposits. But that was a political decision, not a guarantee. If 50, 100, 200 banks collapse, the government won't be able to protect everyone. Congress will tire of voting for bailout packages. The public will rebel. Why are we saving the rich? Real scenario. Depositors with amounts above $250,000 get 60, 70 cents on the dollar. If you had $1 million in your account, you'll lose $300, $400,000. Here's the paradox. If your bank goes bankrupt, your debt doesn't disappear. It gets sold to another bank or collection agency. You keep paying. But here's what happens. Interest rates on new mortgages skyrocket. Under normal conditions, 6.5 to 7%. In a crisis, 9 to 11% because banks are afraid to lend. If you're trying to refinance or buy a home in 2026-2027, you're trapped. Home values fall 18-25% due to the crisis, but mortgages get more expensive. Average mortgage payment for a family buying a $450,000 home. At 6.5%, $2,140 per month. At 10%, $3,950 per month. The difference is $1,110 per month, or $13,320 per year. That's 3 months' salary for the median American worker. Now add inflation. The Fed prints trillions to stabilize the system. QE4, QE5, direct payments. Money devalues. Inflation, which was at 3.2%, jumps to 7.8% by the end of 2026. That means groceries become 40% more expensive over 2 years, gas 55% more, utilities 35% more. If your salary is $60,000 a year, your real purchasing power falls to the equivalent of $51,000. You've lost $9,000 in income without receiving a single layoff notice. For a family with median income of $75,000, that's a loss of $11,250 in purchasing power annually. Savings that were accumulated over 10 years for children's education or retirement have depreciated by a quarter. In the U.S., there are 33.2 million small businesses. They create 64% of new jobs and employ 61.7 million people. 80% of small businesses depend on loans from regional banks. When these banks stop lending, here's what happens. Wave 1. First 6 months, 480,000 businesses close. These are the ones operating on the edge with high debts, unable to survive the credit crunch. 8 million jobs lost. Wave 2, 6 out of 12 months, another 670,000 businesses. Those that were staying afloat, but customers stopped buying due to recession, and refinancing debt is impossible. Another 3. 9 million jobs. Wave 3. 12 to 24 months, 290,000 businesses, victims of prolonged crisis, accumulated losses, inability to compete with large corporations that survive the crisis. Another 1.7 million jobs. Total, 1.44 million small businesses closed. 8.4 million people lost their jobs. That's 5.1% of the entire U.S. workforce. Restaurant business, 3.6% margins, high dependence on loans, first to suffer from falling consumer spending. 38% of independent restaurants close, about 230,000 establishments. Construction, without financing, projects stop. 18,000 construction companies go bankrupt. 840,000 workers, from architects to laborers, lose their jobs. Retail, clothing stores, electronics, home goods, those who couldn't transition online fast enough. 125,000 retail locations close. Shopping malls turn into ghost towns. Auto dealerships, 3,200 dealership centers closed due to inability to get floor planning. Loans to purchase cars for sale. Large businesses are diversified, have access to capital markets, but not all survive. Fortune 500 bankruptcies. 14 companies from the Fortune 500 list declare bankruptcy in 2026-2027. These are companies with high debt loads in retail, energy, and telecommunications sectors. Example, a regional department store chain with $28 billion in debt, rates on which grew from 4% and 9%. The company can't service the debt. Sales fall 31%. Bankruptcy in October 2026. 89,000 jobs lost. Survivors, tech giants with mountains of cash, Apple, Microsoft, Google, defense contractors with government contracts, pharmaceuticals, the largest banks. They don't just survive, they buy competitors for pennies and emerge from the crisis stronger. Recession means falling tax revenues. Simultaneously, expenses skyrocket. Unemployment benefits for 13.5 million unemployed, $89 billion per year. Bailing out the banking system, $200 billion one time. Stimulus payments to the population, $340 billion. Increased spending on Medicare and Medicaid due to rising poverty, $67 billion per year. Tax revenues fall by $520 billion due to recession. Federal budget deficit in 2026, $2.9 trillion. That's 10.8% of GDP, the worst figure since 1945, excluding COVID. National debt soars from $36 trillion to $41 trillion over 2 years. Interest payments, $1.6 trillion per year at an average rate of 4%. Congress is forced to make choices, whom to save. Cuts begin in 2027. Social Security, Payments frozen without inflation indexing. Real loss for 67 million retirees. 15 to 20% of purchasing power over 3 years. Medicare. Coverage cuts. Patient copays increase 35%. Federal aid to states cut by 23%. States are forced to lay off teachers, police, firefighters. Food stamps. SNAP. Stricter requirements. 8.7 million people lose assistance. Politically, this is toxic. Protests, marches, social tension reaches 1960s levels. Level 1, catastrophic. Countries with dollar-denominated debt. Argentina, $150 billion in external debt. Turkey, $184 billion. Egypt, $165 billion. Pakistan, $130 billion. When the dollar strengthens by 18%, servicing debt becomes impossible. Wave of sovereign defaults. Exporters to the U.S., Mexico, 80% of exports go to the U.S., Canada, 75%. When American demand falls 22%, their economies enter deep recession. Level 2, severe. Europe, Germany, France, Italy. Their banks hold American assets. Exports to the U.S. fall. Their own banking system is cracking. Eurozone GDP contracts 3.4% in 2026. China, slowdown from 4.8% growth to 1.2%. For China, this is catastrophic. Without 6 or 7% growth, they can't provide employment for 10 million university graduates annually. Social instability. When every country is in crisis, it becomes every man for himself. The U.S. imposes import tariffs, 25% on steel and aluminum, 15% on automobiles, 20% on electronics. Goal, protect American jobs. Europe responds with counter tariffs. China does the same. By the end of 2027, global trade volume shrinks 17%, the worst figure since the 1930s. The WTO is paralyzed. The G20 can't agree on anything. Each country acts alone. Globalization reverses. Economic crisis in the U.S. is a geopolitical opportunity for rivals. China offers countries in Asia, Africa, and Latin America loans in yuan, investments through the Belt and Road Initiative, an alternative to the dollar. By 2030, 47 countries use yuan for energy settlements. Russia strengthens ties with China, Iran, BRICS countries. An alternative financial bloc parallel to the West is created. Europe, torn between loyalty to the U.S. and economic interests with China. NATO unity cracks. The unipolar world that existed since 1991 is ending. An era of fragmentation, blocks, a new Cold War begins, but this time economic. So let's sum up. We started with a simple fact. The Federal Reserve raised rates from 0.25% to 5.5% over 3 years, the most aggressive hiking cycle in 40 years. This decision, fighting inflation, created $683 billion in unrealized losses in the banking system. 722 banks are at risk. That's 15.7% of all regional banks serving 67 million Americans. We saw SVB, Signature, First Republic fall. We saw the government spend hundreds of billions on emergency bailouts, and we saw the Fed continue raising rates as if nothing was happening. History shows us, when the banking system starts cracking, stopping the collapse is nearly impossible. Right now, in October 2025, we're in a moment that historians will study 20 years from now. They'll ask, why didn't anyone stop this? All the signs were obvious. And the answer will be simple. Because the system isn't designed to stop. The Fed can't sharply lower rates. It'll trigger a new wave of inflation and show weakness. The government can't save all banks. They don't have the money and taxpayers are tired of bailouts. Banks can't just write off losses. It'll destroy their capital. Depositors can't not panic. When your savings are at risk, rationality evaporates. This isn't a conspiracy. This isn't someone's evil will. This is a systemic trap with no easy exit. You might ask, okay, everything's bad, but what should I do? And here's the thing. I don't give financial advice. I'm not a personal finance expert. I'm just showing you a system that's breaking before our eyes. But I'll say this. The largest financial crises in history, 1929, 1987, 2008, they all had one thing in common. In each case, most people didn't believe it could happen until the very last moment. The government won't let it crash. The Fed knows what it's doing. This can't happen in America. And every time, it did. We live in a world where central banks have printed $25 trillion out of thin air over 15 years, where U.S. national debt is 123% of GDP, where interest rates grew 22-fold in 3 years, where 722 banks are sitting on a time bomb, and all it takes to detonate is one bank, one trigger, one moment of panic. Silicon Valley Bank was a warning. But we didn't listen. The question isn't whether the next crisis will happen. The question is, when it begins, will you be ready to watch the system you've trusted your entire life collapse?